Welcome to another edition of Around the Table with Stacy Smith. We are 2 weeks into the new year, and in those 2 weeks, the Santa Claus rally has come to an end and it exited, and concerns entered the market about the same time. All of the major stock indices are lower than when the year began, but is that necessarily cause for concern? Well, that is one of the questions I'm going to ask our astute panel of analysts, and they would like to introduce them to you right now. I'd like for you to meet Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. She is recognized as one of the nation's leading voices on financial advising. As we go around the table, we find Frank Rossetti. Frank has been advising clients for 50 years, and Frank helped to establish Harvest Financial, where he is the executive chairman. Across the table from Frank, we find Kim Forrest. Kim is the chief investment officer and the founder of Boca Capital Partners. Kim has a dual background in both finance and in software engineering, and you may have seen Kim in her many appearances on CNBC, Fox Business, and also on Bloomberg. And our last panelist at the table is a name familiar to a lot of Pittsburghers, Bob Fragasso. Bob has been in the investment advisory business for nearly 50 years and is chairman of and chief executive officer of Fragasso Financial Advisors. I want to thank all of you once again for joining us for Around the Table with Stacy Smith. Now, over the weekend, in the Wall Street Journal, there was what I think a good article by James McIntosh entitled, "Why Has the U.S. Stock Market Done So Well and Can It Continue?" He says there are three reasons why the market in this country has done so well. He cites first a superior economy, which was helped, he says, by the money pumped into it because of the pandemic. Second, he says the pandemic made some U.S. companies the greatest companies in the world. And third, he says that with all of the money pumped into the economy, it made buying stocks a speculative endeavor, which pushed the markets higher. However, he goes on to say, many companies got a big boost to their valuations because of lower bond yields, and it appears that interest rates are headed higher. And he thinks that will present a headwind for the big stocks that dominate the U.S. economy and the markets. And if that happens, it will open the door for European stocks to outperform U.S. stocks, which is something I think all of you as financial advisors have to take a look at. Are U.S. stocks better for your clients or European stocks? Now, many of those dominating stocks he refers to are on the tech side, and we've already seen the tech-heavy NASDAQ decline more than 5% this year. So is Mr. McIntosh correct? And are U.S. stocks facing a headwind? Bob, I'm going to, I'm sorry, Kim, I'm going to start with you. Is Mr. McIntosh correct? Are the U.S. stocks facing a headwind?
I believe Mr. McIntosh has called that correctly, that they are facing a headwind, especially from the interest rate perspective and the liquidity perspective that's the opposite or that goes along with lower interest rates. Essentially, there's more free money. But where I think he got it completely wrong is saying that European stocks are set to win. That Europe is an export-driven economy until the rest of the world can spin up and buy their cars and heavy machinery and wines. We'll just kind of walk around Europe, right? I don't know that they're really poised to. And besides, I think structurally, the US has it all over the rest of the world with respect to how our markets are set up, that they enable companies to come to them relatively free of constraints. The labor market surely is more free here than in other parts of the world. And we have great contract law, which gives investors a lot of assurance that the things that make the companies special can stay within those companies. So right on some, wrong on some.
All right, good. Bob, your take.
I agree with Kim. I think that first, I agree that the author correctly identified us as the strongest economy, but it's because, as Kim said, we're structurally organized to be the strongest economy. We're not going to stop being the strongest economy because interest rates are going up a couple percent. And I don't know that they're even going up a couple percent. The other piece, and I agree completely with Kim, that European stocks will outperform US stocks. Interest rates move together worldwide. There's a timing difference potentially when one country versus another follows other countries that raised rates. But if we raise rates, Europe will raise rates. So that takes away the advantage. And I would conclude by saying how much. Again, high interest rates, inflation, those words they're not definitive just to hear the words. How much are interest rates going up? Are they going back to a normal parameter? Not a big thing. It'll adjust.
It will adjust. Carrie, your take.
Yes, as we look forward, we still favor U.S. companies over international companies. We have such an interconnected world right now. And when you look at the fundamentals of what would cause an economy to continue to grow, structurally here in the U.S., we are much better off. And when we look demographically, we're much better off. So we are definitely watching the data that's coming out of Europe to see if we're seeing economic activity improve over what we have here in the US. And we just haven't seen that, especially with the impact of the pandemic, and that those economies, particularly in Europe, are driven by tourism. So we have to be careful of that. And also, when we're talking about international, we always have to dig deeper as to what type of international. Are we talking about developed Europe? Are we talking about emerging markets? So we definitely have to drill down and see how particular regions are performing. And at this point in time, we still favor US over international.
All right, Frank, I'm going to have you wrap it up here. What are your thoughts?
I agree with pretty much everything that everyone has said. We tend to look a little differently at individual stocks, in that we look at companies and what they're bringing to the world. And if you own Coca-Cola, for instance, that's a U.S. company that's probably doing more sales abroad than they are here. McDonald's, I think, definitely is doing more sales abroad than here. So the question becomes just what is an international stock and what isn't. And Unilever, for example, sells a lot of products in the United States, but it's a British company. So I think that when you talk about international versus domestic, I think the major companies are all pretty much international companies. And if you stick with US-based companies, you have stability that does not exist in most of the rest of the world, especially in light of what's going on in Eastern Europe today, for example.
All right, good point. Bob, the last time we met, you basically predicted that we'd see a lot more volatility this year in the stock market. You said it may not be as much volatility as we saw early in 2020, but you do expect to see some volatility. The markets have been kind of going up and down significantly in the first 2 weeks of the year. Is this what we're experiencing right now, the volatility, as you call it?
That's right. Again, volatility is another one of those words. Do you mean a moderate volatility? Do you mean drastic volatility? Moderate volatility will mark our markets going forward. There are a lot of economic as well as political pulls on the markets as interest rates do edge up, and we believe they will, to reasonable levels. The markets will react in the short term to that, and then they will adjust and assimilate those rises. So you'll see markets drop a bit, recover, and that's the nature of market movement. There's nothing on the horizon that calls for huge volatility that we're seeing right now.
When there is a huge volatility, as you just described it, what should an investor do? Just sit back?
Do not sell, because you won't know when to get back in. When markets go down, and the most recent example is the early part of 20, the first quarter of 20, when the markets sold off drastically. The people who sold out did not get back in. The markets recovered, and I say that categorically. They didn't get back in, and they missed the recovery. You don't know how far it's going to go down. The oftentimes stated refrain is, well, when things settle down and start to move back up, no, you've already missed it. They caught you looking. That pitch went right past you. Don't do that. If your portfolio is allocated properly, you can weather a downturn, even a more severe downturn, if it's allocated properly. And with more time, I'd cite you an example going back to the crash of 29 and the results of it. It works in all time periods.
Well, why don't you go ahead and give us that example from 1920?
Well, there was a Barron's article written in the 1920s. What a widow and two orphans, how that family the father had died, and how should they invest the insurance proceeds? and it was what we would call today an asset allocated balanced portfolio. This was written in Barron's in the 20s. And in the 1960s, the Barron's editors dug that up and resurrected that article and tracked what would have happened to that portfolio. It would have weathered the downturn. It would have ridden through the 30s, into the 40s, through the 50s, into the 60s, and the grandchildren of that woman would have been fully educated, and she still would have had a good portfolio. You got to ride through them if your portfolio is allocated properly, and don't panic because you're going to get out at the wrong time.
All right. Very good advice on that. Carrie, in our last get together, you said that the issue this year, in your estimation, was going to be valuation of stocks. Now, Mr. McIntosh, if I go back to that article again, says that part of the reason that U.S. stocks are up nearly 50% since the end of 2019 is that the rise in valuation of stocks and investors anticipating a faster growth rate in the future. Well, he says that's something that cannot be maintained. You agree?
Well, when we're looking, one of the things that I think was missed in that article is really the impact of technology on these companies. So I do think that we're in an environment where companies have the ability to grow faster because of the application of technology. So when we're considering the issue of valuation, not only do we have to look at what type of a company we're dealing with, but anymore, as we're evaluating companies or evaluating managers that are buying individual securities, we want to better understand what the process is for the application of technology, because those growth rates can continue. And I also have a bit of a thesis about the valuation of companies, and is it really an apples to apples comparison to look at a valuation of a company today and compare it to historical data on valuations when we have so many more people investing in the market? So it's supply demand, and if you have more demand for individual stocks and financial assets, then it would be likely that we would see the price or valuation edge up. So there are a lot of dynamics to justify the valuation of certain companies, but there are always companies that are going to get ahead of themselves. And some of those technology companies, we have seen some real devaluation or prices going down of some of these more high-flying tech companies so far this year, and really over the past year. We've seen those valuations come down.
I want to get into the tech stocks in just a moment, so I'll keep that thought going here. Frank, as I mentioned at the beginning of our recording today, there are concerns about the economy. The University of Michigan's preliminary consumer sentiment index for January fell to the second lowest reading in a decade. Manufacturing production unexpectedly dropped last month. COVID is still forcing a lot of people to call off work, which of course affects businesses. Inflation is running at 7% at this moment. The latest retail sales numbers were disappointing, and also disappointing was the posting of lackluster earnings by the big banks. Is all of this just noise, or is it something that investors should be concerned about?
Well, it's certainly not noise. All these things are factors that play into the future growth and evaluations of corporate America, or the corporate world for that matter. And but on a day-by-day basis, it does seem to whip some emotions around a little bit and cause 2 and 3% pullbacks like we've seen now. This is not a big deal. I wouldn't get too concerned about a pullback in the market until it starts approaching 20%. 10 is just an opportunity to buy in my mind. The likelihood of these things being long-term problems, however, are slim. These things come and go. They've always come and gone. The market has often been said climbs a wall of worry. If no one's worried about anything, run for the hills, because whatever the next worry is going to be will be a surprise. None of these things that they're talking about in the media today are surprises. Inflation's been happening. They've been trying, we've said before, they've been trying to make inflation for 20 years. They finally succeeded. It got a little ahead of where they want it to go, but it's not like a water faucet where you can just dial it back and forward. It's not an exact science. They'll start tightening the money supply. They'll start raising interest rates. But I don't see a long-term problem in the market. And Carrie alluded to the demand side of the markets. You know, the Wilshire 5000 leads you to believe there's 5,000 stocks in that index. Today, there's only 3,600. The volume of available stocks there are to buy is shrinking. People are going private. People are buying back their own stocks. There aren't 5,000 stocks in the Wilshire 5000. There's only 3,600. The market used to have 8,000 or 10,000 public companies. Now I think it's 4,000 or 5,000, 6,000. It's constantly changing. The supply of available securities is shrinking, and yet the money is not, which good old Econ 101, supply demand, when the demand exceeds the supply, the price is going up. That's inflation also. And we've been seeing that in the stock market for a couple of decades, several decades now.
So you raised an interesting point. I hadn't realized that the Wilshire 5000 is not made up of 5,000 stocks anymore.
Not anymore.
Yeah, not anymore. So to all of you, I pose this question. Is that necessarily a good thing, that the shrinkage of the number of stocks that are available for investors? Anybody?
It's a neutral thing. It's a neutral thing. It is.
Okay.
It's a real thing. It's happening. And so you work with what's there. We can't worry about what had occurred before. And the fact that money is following, as Frank described, private investment. Institutions are investing that way, and now many individuals are. That's not necessarily a bad thing, although it requires more caution, because stocks are publicly listed and therefore required to adhere to certain regulatory norms. Private investments have to be legal and ethical as legislation dictates, but they have much more leeway. So it is what it is. It's neither good nor bad. It just requires more caution to find one's way through those investment opportunities.
Piling on here, I agree, because whenever I got into this business in 1999, a lot of those stocks, maybe not in the Russell 5000, but there were a lot of stocks that are deemed penny stocks. And some of them were with defunct companies that didn't have any business part, but they were still trading as a stock. And I think cleaning up those is a great idea, because people get sucked into it's fraud, right? There's people out there that are manipulating stocks. And I say this not to put anybody into extreme caution, but take a look at what that company is. Call up on Yahoo Finance and see if it actually is a going concern or not. But I'm happy to say a lot of those companies that deserved to have a regulatory death were taken off. Now, the larger companies that are buying each other, that makes me a little sad, because sometimes you buy a stock, it's a great company that you wanted to own, but now it gets bought by another larger company. While that's probably pretty good for the shareholder at that moment when it gets bought, you now have to replace that stock, right? So you have to find an equally good company. And that is a good problem to have, but that's what's happening somewhat as well.
I'd like to give you a postscript very quickly. Movement equals opportunity. You're either a seller or you're a buyer. That's not an argument for jumping around, but things are happening in the marketplace. And the more you slow yourself down and say, I want it the way it used to be, the more you limit your opportunities. So you have to go with what is, and you have to do it in a careful, dispassionate way.
That leads us right into the next topic I wanted to bring up, and that's also from that article, and that's on speculation. Mr. McIntosh said that he hopes, quote, the froth isn't indicative of an irrational inflation of the entire market. Sounds a lot like what Greenspan said about irrational exuberance back in the, late 90s, early 2000s. So posing this to all of you, Is there a danger here that the bubble is going to burst? And Carrie, maybe I'll start with you because you brought up about the tech stocks.
Yeah, I think that it's hard when people make blanket statements like, the bubble and is it going to burst? Because what we're really seeing and what we've experienced over the course of the last few months is a rotation. It's not an all or nothing that all stocks go up and down at the same time. This time around, as people have had a fear of inflation and a fear of interest rates going up, that has taken money away from those more speculative technology stocks and pushed them more towards value-oriented stocks or those companies that are more mature, maybe pay dividends. So, we have to be careful about talking about a bubble bursting. There is always the chance that the stock market could go down. And it could happen with something that happens overseas. We wake up one day, a hedge fund has collapsed. That may bring markets down. And we know that generally, higher valuation stocks typically have more volatility. So we want to be careful of that when we're designing portfolios. But, even the correlation between interest rates going up and technology stocks, this is not always the case. We had interest rates from 2016 to 2018, basically double, going from, over 1% to around 3%. We also, during that same period of time, saw technology stocks go up by 60%. So you can't just live in this bubble of interest rates are going up and technology stocks are going down. You have to consider, well, what's the rest of the economy doing? Is the economy still growing or contracting? And right now, as we sit here, what we're trying to understand is that question. Is the economy continuing to grow, or are we seeing some contraction because of a lot of things going on around the country and around the world, particularly the continuation of this pandemic? And I would add to that the support that the government was giving us is now going away. So we have to pay attention to now the growth side of it in terms of the economy.
Stacy, very quickly on what Carrie said that's so important. Technology stocks, once again, not a homogeneous word. It goes from Amazon to startups, and the bulk of tech stocks are in the startup area. There are only so many Amazons and Googles, Alphabet around. So when interest rates go up, those smaller tech startups that are building the new softwares, the new technologies, have a great appetite for capital. So they're going to pay more for the capital they borrow to grow. So when interest rates go up, that level of tech stock will suffer a compression of margin if they even have profits. But by contrast, Amazon has all the money in the world and they don't need to borrow money. So once again, we make a mistake when we categorize something with a word. And so therefore, we're still not relieved. We cannot make generalizations. We're still not relieved of doing the intrinsic analysis of any sector.
If I can ask you, and just to make sure I understand it correctly, and our viewers do as well, basically what you're saying, if it's a company that has to borrow money when interest rates go up, that's going to affect their bottom line. Have I oversimplified it?
If you pay 3% to borrow, you pay 6% to borrow, you're taking 3 cents of every dollar that you have in sales and paying it in higher interest rates. That's a compression of the bottom line. It doesn't go to the bottom line.
So Frank, when you're analyzing stocks, this is something you're looking at as well.
The debt of corporations, absolutely. The debt equity ratios and the enterprise values versus the market capitalization, these things are critical. The enterprise value, just to educate, is basically the sum of the market cap and the debt. And that's the money that they have to work with, in theory, to do their business, whatever it is, whether they're building cars or planing lumber or selling food. And how they are able to use that money for profit dictates whether money's expensive or not. If you're in a high margin business, like most tech companies are, that once you have sales, you run with profit margins of 40, 30, 40, 50%, those are high margins. If you're in the food business and the margin's 5, 10%, you've got a problem when interest rates are rising if you're borrowing money. So in the analysis of a corporation, you have to look at the actual business they're in to determine what the likelihood is of interest rates hurting their bottom line tremendously. High capitalization companies like steel and autos, they borrow a lot of money to build factories. That's fixed. Once they borrow it, it's built. Usually that interest rate isn't going to float around. So they're not going to be as impacted unless they want to build a plant now, like the chip manufacturers are doing.
Okay. Anybody else want to jump in here before we change subjects? Nope.
Well,
Okay.
I would just say, Stacy, that building on what Frank just said, it's not just even the ratios. It's really, well, what kind of debt do they have? Do they have floating debt where, those interest rates are going to readjust, more quickly, or is it long-term debt? What interest rates are they locked into? So, when you get into stock analysis, interest rates going up can definitely have an impact on those more speculative companies that are borrowing money, but it can also have a dramatic impact on more stable companies that just have a lot of debt and a lot of debt maturing.
All right, Carrie, thank you. Well, now it's time for us to check in with Kim and find out her latest stock suggestions. Before we hear from Kim, I want to stress that under the rules and regulations of the SEC, I should say, Frank and Carrie and Bob are not allowed to state publicly any stock picks, and that anything that Kim touts is her suggestion and only hers. Having said that, Kim, you've made 6 selections so far, and here's where things stand. Xilinx is up 28%. VF is down 2%. J&J is up 5%. Morgan Stanley is down 2%. Micron is up 18%. And your last pick from the last time we got together, AT&T, is up nearly 7%. That puts, as my calculations are correct, your overall portfolio on around the table, showing an increase of 10.74%. So, Kim, here's the question. What's your stock pick this week?
So I always have to start out with this. This is not my recommendation for you, whoever you are listening. You have to do your own homework. You have to make sure that these are in line with your goals and aspirations. And even though those are lovely numbers that Stacy just said, there is no correlation or there's no expectation that prior results should be expected in the future. So there you go. How about that? Anyhow, moving on. How about something that Frank mentioned earlier? Oh, sorry, he was just talking about it. He did not recommend it. Coca-Cola. Coca-Cola in the near term, like in a year or so, could benefit if we all go back to dining out, because that's where a lot of their sales are. But the company has restructured itself under its relatively new, probably 5 or 6 years being the head of the company, the CEO. He has gotten the company away from soda into more water and coffee, actually, for the first time. And Coca-Cola is going against the very beginnings of their founding as a company, and they are going to start adding alcohol to the menu. And we think these items about branching out from sodas, it may be able to drive the revenues of this company and let it outpace its peer Pepsi, who seems to have gone into the salty food category as its diversifier and growth engine. So there you have it, Coca-Cola. Oh, and it has a nice healthy dividend of about 2.7%. So I always like it when you get paid to hold a stock. You'll get some cash from holding Coca-Cola.
Wish it were 7%, wouldn't you?
Yeah, I know.
that would have been really good.
Yeah.
All right. I want to thank all of you for joining us once again, and to Frank and to Carrie and to Bob and Kim, thank you so much. And also to our viewers, thank you. And I hope that you would join us again next time for Around the Table with Stacy Smith.
This has been a CBSN Pittsburgh special presentation. We now return to our scheduled programming in progress.